Right now, there's a stock trading in 2 different countries, at 2 different prices, and Wall Street is watching to see which one is right. It's called SK Hynix, and a couple weeks ago, it did something no Korean company has ever done. It walked onto the New York Stock Exchange floor. Well, technically NASDAQ, and listed shares that American investors can buy directly, for the first time ever. But here's the twist. The same company, the same business, the same balance sheet is priced almost 30% higher in New York than it is back home in Seoul. So today, we're breaking down why that gap exists, whether it's about to close, and what's coming in the next 2 weeks that could make or break this trade. Let's get into it. Okay, quick primer if you're just hearing about this. SK Hynix is the second biggest memory chip maker on the planet, right behind Samsung. If you've heard the term HBM, high bandwidth memory, that's the chip sitting right next to NVIDIA's GPUs, feeding data into every AI system you've heard of. SK Hynix basically owns that market right now. And a few weeks back, they launched American Depositary Receipts, ADRs, on NASDAQ. In plain English, you can now buy SK Hynix through a normal US brokerage account, no Korean trading account required. That's a big deal, but the reason it's a big story is what happened to the price the moment US money could touch it. For decades, Korean stocks have traded cheap, like structurally cheap. Investors even have a name for it, the Korean discount. Why? 3 reasons, roughly. 1. Most big Korean companies are still run by founding families, and minority shareholders have historically worried those families call the shots for themselves. 2. These companies are usually massive tangled conglomerates. Samsung alone touches phones, TVs, appliances, chips, and semiconductors manufacturing, all under one roof. That's really hard for an outside analyst to cleanly value. 3. There's a sense that the government's fingerprints are all over Korean corporate decision-making. Add it up, and Korean stocks have traded at lower price-to-earnings ratios than basically every other developed market for years. But here's the interesting part. SK Hynix might not actually deserve that discount. Unlike Samsung, it does one thing: memory chips. HBM, DRAM, NAND. That's it. No phones, no TVs, no foundry business. It's about as clean and easy to value as a Korean megacap gets. And with the AI boom putting memory chips front and center, that simplicity has suddenly become a superpower. So if SK Hynix is a cleaner company, shouldn't the NASDAQ listing just fix the discount, close the gap? Not so fast. Here's where it gets genuinely interesting, and where a real trading opportunity, or trap, might be hiding. Normally, when a stock trades in 2 markets, arbitrage keeps the prices locked together. Big institutional traders buy wherever it's cheaper and sell wherever it's pricier. And that buying and selling pressure crushes any gap almost instantly. Look at TSMC, the gold standard example. Convert the currency, adjust for the ratio, and TSMC's US shares and Tae-won shares are within about 1% of each other, practically identical. SK Hynix? Not even close. Right now, the NASDAQ shares are trading at roughly a 32% premium over the equivalent Korean shares. Same company, same everything. Just a third more expensive in New York. Why? Because the plumbing isn't built yet. There are regulatory limits right now on how easily you can convert Korean shares into these new ADRs. So the arbitrage machine that keeps TSMC locked together simply can't operate at full strength here yet. Now here's the double-edged sword. As those restrictions loosen, and they're expected to, that gap should shrink. Which sounds great if you're already in Korean shares, but if you bought the American shares at that 32% premium, that gap closing could mean the US price coming down to meet Korea, not the other way around. So the Korean discount closing story is real, but it's a two-way street, and right now, US buyers are the ones sitting on the expensive side of it. Here's your calendar alert, and it's a big one. SK Hynix reports earnings on July 29th, just weeks after this NASDAQ debut, and the timing could not be more loaded. Consider where the stock already sits. It's up roughly 80% year to date. The ADR is priced at that 32% premium we just talked about. That is a lot of optimism already baked into the price before a single earnings number even comes out, which means the room for disappointment is basically zero. If guidance comes in soft or margins wobble, this stock does not have a cushion. It has a cliff. And there's already a warning sign. The Korean-listed shares have been pulling back recently, partly a broader AI stock cooldown, partly plain old profit-taking after that huge run. Investors who rode the stock up are starting to take chips off the table before earnings even land. So market. July 29th. That's the first real stress test of this entire NASDAQ listing thesis. Two more factors quickly, because they matter and they get skipped constantly. Currency risk. SK Hynix reports its actual results in Korean won. You're buying in US dollars. So even if the business crushes it, if the won weakens against the dollar, your return as a US investor takes a hit anyway. That's a variable you simply don't have when you own, say, Micron. It's an extra layer of risk baked into every ADR trade. Index inclusion, and why it's not coming soon. A lot of retail investors assume a NASDAQ listing means instant inflows from index funds and ETFs. Not here. SK Hynix isn't expected to qualify for the Semiconductor Index until roughly September 2027. So if you're expecting passive fund buying to prop this stock up soon, you're going to be waiting a while. Now, despite everything we just walked through, the people running this company are about as bullish as it gets. SK Hynix's CEO has gone on record saying memory demand isn't cyclical anymore, it's structural. His actual prediction, 2027 could be the worst memory shortage year in the industry's history, and demand could keep outrunning supply well past 2030. And just this week, Tae-won, chairman of SK Group, backed that up publicly. His quote, paraphrased, "Memory demand is only going one direction, and instead of trying to trade the swings, investors should just hold the stock and let time do the work." He compared the recent pullback to a market simply catching its breath after overshooting, not a sign the story is broken. And to be fair, the swings he's talking about are real. The Korean shares hit an all-time high near the end of June, then dropped by roughly a third in just a few weeks. That's not a typo. A third. That's the kind of volatility that scares off short-term traders and rewards exactly the just hold it mentality he's describing, if he's right. Here's the thing though, memory chips have burned investors with this exact "this time it's different" story before. Historically, this is one of the most boom and bust corners of the industry. Stocks in this space have a habit of rolling over before the actual business slows down, just on the fear that the good times can't last. That's exactly why memory names have traditionally traded at lower multiples than other AI-adjacent chip stocks, even in the good years. So you've got a legitimate structural bull case from the people who run the company, going head-to-head with a sector that has a long, well-documented history of humbling anyone who gets too confident. So where does that leave us? A cleaner business than most Korean megacaps, a real valuation gap that could close over time, but also a US-listed stock priced for perfection, heading straight into an earnings report with currency risk on top and index fund buying still over a year away. This is a know what you're actually holding stock, not a close your eyes and hope stock. If you found this breakdown useful, hit subscribe. We're covering the July 29th earnings the moment the numbers drop. See you in the next one.